Colleagues, good afternoon. Welcome to RAEX Sustainability webinar 40. And today we'll be talking about climate risks for the banking sector. This webinar, just like the previous webinar with Carbon Trust and the European University and EthnoExpert, will be supported by simultaneous interpretation. To enjoy it, please pick the globe sign, and there you can select either English or Russian. We'll have English and Russian speakers today, so you can switch between the channels as you please. If you have any issues with interpretations, then you are most likely to be using the mobile version of Zoom, so please update in this case. If you have any technical issues, you are welcome to ask them in the chat, just like any questions to the speakers. Well, today we'll be talking about TCFD reporting for Russian banks, climate and carbon strategy adaptation by banks. We'll talk about TCFD introduction and practical how-tos, including climate scenarios analysis. We'll talk about risks and opportunities related to climate for banks. We'll talk about the results of ESG assessment of by RAEX-Europe, of the largest banks in Russia, and we'll talk about ESG KPI, SD KPI standard. Today we'll have speakers from Carbon Trust, Tom Cumberlege, Gregorio, Giorgi, and we'll have Elema Shonya with us from the university, and we'll have Dr. Axel from ACM company. And we'll have the RAEX-Europe with you, me and my colleague Denis Anahov. So now the floor goes to Tom Cumberlege. The floor is yours.
Tom, you can connect now.
Great. Hopefully you can hear me okay.
Yeah,
Great.
We can hear you well.
Great.
The presentation is not full screen yet. Yeah.
There we go. Perfect. All there. Great. Thank you. Thank you, Svetlana. And good afternoon, everybody. Nice to be speaking to you again. So as introduced, today's topic is about TCFD, the Task Force on Climate-Related Financial Disclosures in the Banking Sector. Specifically in Russia. So for this first part of the presentation, if you can move us on to the next slide, Gregorio, I'll be giving a quick introduction to TCFD. Then our colleague Elena from EthnoExpert will be providing some overview of the risks and opportunities to the banking sector. And then my colleague from the Carbon Trust, Gregorio, will be walking us through the particular steps to conduct TCFD analysis. So by way of quick introduction, for those of you who haven't been on these webinars before, Carbon Trust is an independent organization. We work with businesses, with governments around the world to help them understand how they can transition to a low carbon economy. And as we've been running these webinars in partnership with EthnoExpert, with RAEX and also the Moscow Exchange on a number of different sectors in Russia, and developing some guidance documents that's going to be available shortly after these webinars. So today's topic is again on TCFD. I'll give a quick introduction and then pass on to Elena. So if you move us on to the next slide, please, Gregorio. So TCFD, just a quick context setting then, very briefly. TCFD was established by the Financial Stability Board of the G20 back in 2015. And it's established because essentially climate change is obviously going to have a significant financial impact on the global economy. Currently, it's not well understood by risk management, by pension funds, by investments, by insurance community, precisely how these risks will unfold. And so the objective of the TCFD is to try and encourage greater transparency around climate disclosures and encouraging organizations to really look at those specific risks and opportunities that are relevant to their business and the sector that they sit in, and to provide that information openly to investors so that increased transparency and confidence can be taken in terms of investments, insurance risks, and long-term relationships with those businesses. So what this diagram does is essentially tries to break down the ways in which climate change will be having both physical impacts and in our efforts to manage the increase in global temperatures to try and limit that, those transition risks and the effect of introducing regulation, changing markets, introduction of new technologies, etc., and the disruption that may cause the global economy as well. So on the horizontal axis, we have temperature. You can see 2 degrees on the left, 6 degrees on the right. And obviously with temperature increase comes greater physical risk. So the longer we leave action towards climate change, the greater the physical risks become, to the point where we have failure to act and catastrophic impacts of physical impacts of climate change. Conversely, on the vertical axis, we have those transition risks. So if we achieve an optimum transition, we have an orderly transition where we manage the physical risks effectively. We have a gradual transition towards a low carbon economy. We have a nice orderly transition where there's low transition risk and low physical risk. But conversely, if we leave our action too late and then we have a rapid transition in terms of increasing carbon pricing, extreme disruption to certain sectors, we'll have that disorderly transition, and the impacts from a transition risk will be much, much greater. So the objective really of TCFD is to encourage this disclosure, to encourage the discussion at board level, to encourage businesses to use that forward vision to understand how their specific risks and opportunities will impact their business, and to develop strategies effectively to mitigate those and to maximize on those opportunities that this transition presents. The key challenge is obviously predicting the future. You can have a range of different outcomes when it comes to climate change. We can successfully try and limit warming to 1.5 degrees, or we have any increase in temperature above that. So the objective really of TCFD is to encourage organizations to look at a range of different scenarios and to effectively evaluate how their business will cope amongst those different scenarios. So my colleague Gregorio will be walking us through the effect of conducting TCFD analysis from the point of identifying, prioritizing, and then quantifying those risks and opportunities. If you move us on to the next slide, please, Gregorio. So TCFD is essentially a disclosure framework. So there's 11 questions across 4 key categories. First one being governance here. So effectively, what oversight does the senior leadership of the business have? What accountability do they have in terms of the climate change risks and opportunities? Then the next section down around strategy, to what extent the businesses has looked at the future horizon and identified those risks before they manifest themselves and effectively change their strategy so that they become more resilient. There's also a risk management criteria, so the process for identifying and prioritizing those risks and whether or not they're overall integrated within the overall risk management framework of the business. And then finally, in the central piece there, we have metrics and targets. So what key performance indicators is the business using to measure those risks and opportunities, and indeed their own climate change impact through greenhouse gas reporting and setting targets to reduce their own impact on the climate. So those are the key areas of TCFD. If you move us on to the final slide in this section, please, Gregorio. So many of you will be familiar with this. It's the TCFD framework, which categorizes risks and opportunities into specific types. So on the far left, we have the transition risks from policy, legal changes, maybe linked to carbon pricing or changing from product standards. We have a transition risk in terms of new technologies coming in, maybe disrupting older technologies, making them stranded assets. We have changes to market and indeed a reputation of organizations as well, suffering in terms of a risk perspective if they don't transition in time. Also, we have the physical risks, being those acute extreme weather events or the long-term changes to our climate, giving rise to extensive heat waves or indeed sea level rises in many areas. So on the far right, we have the opportunities ranging from resource efficiency, opportunities to use less energy, obviously, alternative energy sources, renewables, the opening up of new products and services and different markets to offer those services to, and indeed resilience being a key aspect here. So showing to your investors, to your communities that you have identified a range of risks and opportunities and that your organization is indeed resilient and forward looking and credible in that regard. So All of these risks and opportunities can obviously have financial impacts. And this is the challenge for most organizations, is how do you transition from the identification of these risks and opportunities to actually quantifying the financial impact on your business. So clearly they'll have a range of impacts on a number of different financial metrics, whether that's revenues, expenditures, impacting the income of the business, or whether it's the ongoing balance sheet in terms of liabilities or capital or valuation of assets. So my colleague, as I said, Gregorio, will be walking us through in the third section of the webinar today to walk through the practicalities of how you move from the top of this chart, from identifying a long list of risks and opportunities that are relevant to the business, how you prioritize which ones to look at in more detail, and how you go about quantifying those in terms of the financial impact to the business. But first, before he does that, I will pass over to Elena, who will take us through the specific risks and opportunities to the banking sector. So, Elena, over to you. Thanks.
Yelena, you're on mute. Could you please connect? You're the next speaker.
A little bit slow, you know, just when you're on your own on your computer. So thank you very much. Can you please switch to the next slide? Here is the definition of a banking sector. Definition in a footnote, you can see that it is, I deliberately selected definition from not TCFD, from somebody else's, but from SASB, just to demonstrate you that there are many initiatives that are trying to put together, you know, just all the different, harmonize all these systems. And I believe as a former officer of the World Bank Group and a former commercial banker, that TCFD is the most comprehensive system. So I appeal to all the participants to pay a very good attention to these criteria. So definition of banking sector, we work in a banking sector, which is defined as a business of commercial banks. Not the entire, just for the purposes of this exercise of these presentations, we are not talking about the financial system as a whole, but we are only single out commercial banks that accept deposits and make loans to individuals and corporations, as well as engage in lending to infrastructure, real estate, and other projects. And by providing these services, the industry serves an essential role in the functioning of global economies. And it is driven by the volume of deposits, quality of loans made, and here comes the climate-related risks, and also the regulatory environment that governs the commercial banking industry, as the potential to impact shareholder value and sustainability performance. And the common drive, just if it put it in one sentence, is to translate the climate-related risks into impact assessment. So to translate risks into the cost of money or cost of loans that would be provided to the end clients. The main barrier, as I see it, for the uptake of TCFD in the banking sector is the lack of a single harmonized disclosure framework. And this is what we are doing here, you know, just to create this single framework. And regulators and reporting bodies should work to bring more standardization. That's why we have RAEX here with us. And as people who are dealing with climate-related risk, we come across such abbreviations as GRI, SASB, TCFD, CDP, and so on. And those who has to deal with the climate-related risks have are supposed to have a good knowledge of all these abbreviations. And I believe that interest in TCFD reporting and ESG ratings in the banking sector, although remains weak, but however, risks themselves related to climate change, they received more attention in the Russia financial sector recently. And we know that we have, like, besides RAEX, we have other rating agencies. There are 5 on the market that can assess relevant green financial instruments, including bonds and loans. And since February of this year, the Bank of Russia has begun to recruit employees for a new division that will deal with issues of sustainable development. And also we're expecting to have a report by September 1st on action plan to mitigate the risks of a possible negative impact on the Russian economy and financial markets due to reduced demand from global capital markets participants for assets with high climate-related risks. So can we switch to the next slide, please? Main transition risks for the banking sector. The banking sector, I would say, the main risks for the banking sector, they come into two streams. These are physical risks for the banking sector. They are divided for acute and chronic risk. And most experts believe that transition risks are the main risks related to climate for the banking sector, because they are the financial system is exposed to climate change through two broad categories. And transition risks arise during the adjustment to a lower carbon economy, such as mentioned here, policy and legal risks, new technologies. Some technological solutions implemented early in the transition phase may prove obsolete as better solutions are developed, for instance. And we know that such instances happened in banking quite often. And lack of innovation and equipment available also could be just another technological risk. And also market sentiment shifts. It means that people are no longer want to consume something which is not green related. And increased demand from investors for inclusion of ESG factors and high quality climate related disclosures also impose considerable reputational risks on the company. And also with the, we know that the new regulations are coming on, and it will bring more cost on the compliance. And many banks are complaining this is not their core business. However, they have to meet these requirements and prudential policies from the regulators, and they have to recognize, they will have to recognize systemic climate risks and in the future. And this is the trend that we cannot reverse. Also, as banks are following their client base, they would of course face the same climate related risks as their customers do. And because the concentration of the banking sector is quite high, so we know these sectors, they're just the main sectors, 3 that banks are financing. And I think that these indirect exposures or indirect risks would also bring influence decisions of the banking sector with regard to which sectors and which projects and which investment decisions to make in the future, as the requirements of the different stakeholders raise towards the clean and green economy. So I think that it is not only risks that we are facing now. It is also, could we switch to the opportunities page, please? It is also the opportunities that arise for the banking sector. New opportunities in new markets are related to low carbon, green economy. And we have pioneer banks that are best in their class already, despite the fact that not all the banking sector is well aware of such banks that are already doing this green lending. For instance, one of them in Center Invest Bank that has just a big portfolio and also was quite active in issuing bonds, green bonds. And so as well as some other projects that even you as bankers, you come back to to your bank and then look at your portfolio, and after a very close look, you'll find out that no less than, I don't know, just from 2 to 15% of your entire bank portfolio could be regarded as green. We just don't do this business systematically. And I believe that these new frameworks that when specialized senior personnel is responsible for this direction of business, or minimum standards within the bank are set up, and processes, methodologies, and tools identified necessary to manage climate risk effectively. And the main thing that I would say is just that climate-related risks should be consideration of them should be embedded into risk and credit frameworks, top down, down top, and into decision making. And the opportunities are also in the new climate-related asset classes that the banks would be working with, new financial instruments such as green loans and sustainability-linked loans, which are already well defined by Loan Market Association. And I know a couple of Russian banks that are already issuing green loans and sustainability-linked loans. And those who are not doing it, I believe that they will be doing it very soon. I mean, this is almost all that I wanted to tell. And when you start from scratch, so you have to just remember that the approach should be systemic, then the offer on green lending should be available within a bank. Then the operation model should be fine-tuned, and everybody in the bank should know that you are doing this green lending. And also measurements, methodology, monitoring are very essential, since if you don't report properly, so it means that it may not, such kind of business does not exist within the framework of your bank. So I think that this is all that I wanted to tell in this little presentation. And it is difficult, you know, just to present when you don't see the faces of the people. But I would like to have the feedback from the participants. And I want you to actively participate in a little answering this little questionnaire that we prepared for you, and this little polling. So
thank you, Elena. My colleague Denise will now launch a polling. I think our listeners, some of them probably remember the polling system from previous time. Elena will clarify the questions shortly, but to your information, please answer this polling as this information will be used for further research and accumulated from all webinars. It's very important that we get your feedback. And also at the end of the webinar, all sets of pollings will be discussed. Elena, I give it back to you. Gregorio, we have a small issue with the polling, so maybe we will go directly to your presentation and then go back to Elena's polling.
No problem at all.
Okay, thanks.
Yeah, we'll crack on with the presentation. And hello, everyone. Hello to all the attendees. My name is Gregorio. I'm a senior associate at the Carbon Trust. And today I will be talking you through some practical tips on how to approach and implement a TCFD project, giving specific examples of financial quantification and scenario analysis specific to the banking sector. So before I start, I want to reiterate that disclosing to TCFD should be considered very much as an iterative process that is continuously improved over time. So the expectation by investors, regulator, and other relevant stakeholders is not necessarily that you get everything right the first time, or you disclose across all areas of TCFD, of the framework, so those 11 questions and 4 different areas. But their expectation is really that you take that first step from going from not disclosing anything to disclosing something. And obviously that first step is possibly the hardest, but again, it's good to keep in mind that even a partial disclosure is far better than not disclosing at all, and can really send a strong signal to your stakeholders and to your investors and to investor community about the position you're taking on climate change. So how can you take that first step? So there are many ways to approach a TCFD project, but here at the Carbon Trust, we usually do it by dividing into these 3 simple phases. So the first step will be to identify the climate risk and opportunities that are relevant to you as a bank. The second will be to prioritize these risk and opportunities based on their materiality and the certainty of this risk materializing over time. And the third one is the quantification. So understanding the financial impact of this risk and opportunities on your business. And one thing to know here is that you can disclose at any of these stages. So depending on where you are and what kind of your positioning wants to be, you can disclose after you have identified the risk, after you have prioritized them, or after you have quantified them. And that will depend also on the technical knowledge of your teams. So now I'll give a bit more detail into each of these steps. So starting off with identification. So this step comprises 2 sub-steps like that you can see here. So the first one is the long list. So the very first step is you have to start compiling, listing all the different risks and opportunities that you think are relevant to your bank. So normally this would entail developing an understanding, pretty in-depth understanding of the business model, of the different characteristics of a specific company. But because banks, they have exposure, they have a relationship through loans, through investments into different sectors. This is a bit more complex for banks, and it is recommended to do that exercise for the different sectors of the portfolio that of your specific portfolio, as well as for different kind of financial instruments that you're using to engage with these counterparties. And to gather this information, you can host workshops or interviews internally within the bank, or also with your counterparties, as well as you can gather information on kind of macro trends or more kind of industry-specific information through desk research and kind of reading industry reports, and also through your own kind of data analysis. So that's the long list, and you should aim, it's very difficult to say how many risks you should aim for, but we usually tend to aim for about 100 to 150. So it's a pretty hefty kind of long list. But yeah, that's really dependent on the nature of your business. Secondly, as you compile the long list, it's very important that you start categorizing the risk and opportunities. So you can see different types of categorization here on the screen. None of these are really required except the TCFD category 1. So it's really important that you categorize your risk the same way that the TCFD framework categorizes them for consistency and transparency purposes. So just to give you an example of what that long list might look like, and again, this is just for illustration purposes only, but let's say you're a bank that has investments or has relationship with the oil and gas sector, the power utility sector, as well as the real estate sector. A risk could be carbon pricing that increases the cost of operation of that counterparty. So you will classify that as a policy and legal risk in the TCFD category. Then you will look at the external root cause. So what is the origin of that risk? So that is that can be led back to the introduction of a carbon tax. You also want to understand what is the value chain stage of your bank that is being affected. And again, a bank value chain stage is perhaps not as clear or as obvious as a normal corporate. For example, a steel company where you have your upstream operation and downstream. But it's really good to break down the risk and really understand the value chain stage that is being affected, or the part of the bank that is being affected. In this case, it could be loans, because you could be loaning out money to the bank, to the company. Then you also want to look at the value driver affected. So which part of which financial metric is being impacted. This could be revenue or cost, as well as the geography, whether it's a company in Russia, whether you have operations throughout Europe or throughout the world. So it could be Russia or global. And also the time horizon, whether you think this risk will be materialized in the short term, in the medium term, or in the long term. So the next step will be to prioritize the risks that you've identified. So you have this long list of 100 to 150 risks, but you really should focus your analysis of the most material and the most certain risk that will happen. So starting with step 2.1, the first thing that you should do is to assign a quantifiable parameter to the identified climate risk and opportunities. Basically, what this means that you understand something that is quantifiable to the risk, so to understand how the risk will evolve over time. So you're trying to answer the question, how can I measure how this risk will change over time from today to 2050 or beyond? And you're really looking for a good indicator of that change, indicator that will reflect the change of that risk. And this is effectively the first interaction with climate scenarios and scenario data. And in just a moment, I will share some common sources that we use to source this data. And later in the presentation, I will give an example of how to put this into practice a bit more. So once you've assigned the parameter to the risk, it's also important to assign a value driver to that risk. So basically a relevant financial metric of the bank that could be impacted by this risk. So in the case of the carbon pricing risk that I was just mentioning, it could be a revenue from loans made to oil and gas companies or to the power utility sector. Then we move on to 2.2, which you start assessing and scoring the risk against a set of 6 criteria that you can see here in the bottom of the slide. And just picking out a few, so the confidence level, this is a qualitative score, so you should rate how confident you are in the parameter that you have selected for this risk. So how well does this parameter represent the risk, and how reliable is the source that you've used to source this underlying data, will give you the confidence level. And then the other example is the financial indicators, and this could be either qualitative or quantitative. And this is effectively a first step in understanding the materiality, so the financial quantification of that risk, which we'll go into depth in just a moment. So here, I just wanted to share a couple of resources for the scenario analysis. Just want to mention that there are different types of scenarios. So from transition scenarios on the left-hand side to physical scenarios on the right-hand side. So starting from the transition, you have sector-specific models and different sources that look at the evolution and the pathway of different industries over time and how these will decarbonize. So a good example would be the IEA's energy technology perspective or the World Energy Outlook. In the middle, you find integrated assessment models. So these are models and kind of scenarios that bring in socioeconomic and physical factors into the future outlook. So it's a bit of a combination of physical and transition brought together into one, which are a bit broader in terms of what the level of granularity you can get, but they're very helpful in understanding kind of that system view of the different implication of climate change and of those specific risks. And then on the right hand side, you have physical scenarios, so understanding really related to the physical risk that you have identified. And this will be shared with you after webinar, so you can, you can refer back to these at any time. And here I wanted to, so once I mentioned scenario data, I also wanted to quickly show you the financial metrics that should be considered in that second step. So TCFD recommends looking at 4 key financial categories, like Tom mentioned. So you have your revenues, expenditure, assets and liabilities, and capital and financing. And under each, you will see the different value driver of the company or of the bank that is impacted. And again, this exercise for a bank is slightly more complex because the revenue of a counterparty, or sorry, the demand of a product of a counterparty will dictate the revenue of the counterparty, which will subsequently dictate the revenue of your own revenue effectively. So it's a bit of an extra step in understanding how these value drivers are affected for banks. Great, so then here is the same table that I was showing earlier with our risks that we have identified, but I just wanted to give you an idea of how the scoring actually happens. So you can see our risk on the left-hand side, and you can see that we have assigned a parameter to each of them. So for the carbon price, we're looking at the price of carbon expressed in dollars per ton of CO2. For the second risk, we have chosen the parameter of temperature increase to understand how the value of real estate assets, so the values of mortgages, might be impacted by a reduced permafrost bearing capacity over time. And I'll give an example of these two risks in just a moment. So here, I guess the focus is really understanding the parameter that we're assigning. And the last risk is the increased investor demand, which is very hard to assign a parameter to. So in this case, we have left it as a qualitative assessment. And here you can see, once we have the parameter, we can also score each risk. So in this case, we're confident that the source that we have chosen is robust, the data is reliable, so we're given a high score. We're given a medium scenario sensitivity score, which means that under different scenarios that we're considering, there is a divergence of between 25 and 50%. In terms of probability, we're given a very high score because the trajectory, the kind of direction of travel of both of the risk under both scenarios is the same. So the slopes of the two curves are effectively the same. So it's very likely that this risk will materialize. In terms of time horizon, we expect this risk to happen between, within 5 years. So we're given them 3. And then financial impact in this case, we just express as the value of your interaction, of your engagement with this company, which will be in this case the value of the loan. So why is it important to assign the score? Because then you can actually and systematically prioritize them. So you can see our 6 criteria, we have used it to calculate the materiality and certainty. So you can see the materiality on the y-axis is the function of time horizon and financial indicators, while the x-axis is a function of those 3 criteria: confidence level, scenario, sensitivities, and probability. Again, the prioritization is very important that we give scores to this risk so then we can understand and compare objectively the certainty and materiality. So in this case, we have the reduced permafrost bearing capacity risk and the carbon pricing risk as falling into the proactive quadrant, while the investor demand falling into that non-material quadrant on the bottom left of the chart. So by scoring, we can also then assign to each risk a risk mitigation response. So it's very important that we do this objectively, again, and systematically. And the last stage is the financial quantification, which effectively means understanding how the financial impact of the risk under the 2 different scenarios that we're considering, compared to a scenario which climate change doesn't exist and which all the projection of the company will remain as they are, a business as usual scenario effectively. So the difference between the scenario and the business as usual will give us the cumulative loss for the risk, but also the potential value, potential opportunity value creation for that, for the opportunities. And I just want to close by giving you these 2 examples of 2 risks that we have identified, we have prioritized, and now we have to quantify them financially. Before I do, I just wanted to share that to please bear in mind that these have been simplified for the purpose of this webinar, and that almost certainly there will be more complex calculations from a bank perspective to do, but we just wanted to show you how to go from identifying a risk to understanding the materiality in terms of financial quantification. So this first risk consists of increased temperature leading to a reduced permafrost bearing capacity, which will impact the value of real estate assets that are located on this permafrost, as they're being damaged or they fully collapse as a result of the instability of the ground which they're built on. So the assumption here is that the banks own real estate assets in these permafrost areas. So the first graph on the left, you will see the average temperature. So you will see that this is the parameter we have assigned to the risk, and we have sorted the expected average temperature increase in this particular area in Russia from this database, the KNMI. And we're considering in this case a 2-degree scenarios and a high emission scenario, which you can see the corresponding name of the scenario here, 2.6 and 8.5 respectively. Secondly, once we understand how temperatures will evolve with time, we have to understand how higher temperature will impact the thickness, so the bearing capacity of the permafrost. And here we've used we've sourced this from an academic paper, which gave thresholds of temperature increase or temperature, air temperature, and the thickness of the permafrost. So you can see that, as temperature increase, the permafrost bearing capacity decreases, which results in a less stable ground. Then we convert this change in the permafrost bearing capacity into a level of risk for the real estate assets. And here we assume a linear relationship, which effectively means that if the permafrost thickness reaches a certain threshold, then more of the assets that are located on the permafrost areas are at risk of either collapsing or being damaged by the lack of stability. And this is, of course, a simplification, but we just wanted to show again how you can go from just the risk to quantifying that. And lastly, on the right-hand side, you can see the value at stake, which is the cumulative loss of the value of that real estate over the years under the different scenarios. And lastly, the last example I wanted to give you is the scenario in which a bank makes a loan to a power utility company, and a carbon tax is introduced. So the power utility company struggles to pay back the loans because their operating margins are shrinking or go negative as a result of that. So again, the parameter here that we've used is the carbon price. So we are projecting the price of carbon in the different scenarios. We then assume that the only factor affecting the operating margin of this company is carbon price. So we are basically linking the two. So as carbon price increases over time, the operating margin decreases over time. And you can see that this line here, this gold line here is the zero. So it will effectively be a loss. And to do this, we have used, you can use company data, so emissions, revenue, operating margin, you can source from the company themselves. And then you basically understand, okay, the operating margin becomes negative in 2026 from the 2-degree scenario, in 2039 the 3-degree scenarios, which means that the company is no longer able to pay back the loan installments effectively. And the value at stake is basically understanding, okay, for the 2-degree scenario, what's the cumulative value of those loan repayments? You can see that in the 2-degree scenario is a lot higher because the operating margin again becomes negative very quickly, while in the 3-degree scenario becomes it's not as big because it becomes negative in 2039. So the company will have paid back the loan. So that was it from my side. I'm aware that we went through a lot of questions, but yeah, if there's anything, please write in the chat and we'll be happy to take any questions at the end of the session. I believe now we can do the polling, Denise.
Yes, thanks, Gregorio. Now we have polling working normally, so we need to launch first the first set. Currently, the first set is launched. Please vote on it.
So I can switch on my presentation right now.
Yeah, I think you can start switching to the presentation, but the polling still goes on.
I will switch on Russian channel.
Today we'll talk about the ESG assessment by RAEX-Europe of the largest Russian banks. Let me start with the traditional part. So we'll talk about our ESG base. Let us wait for the polling results. Well, I will not close polling, so those who want to answer, they'll be able to do it. So we'll keep it in the background. Okay. Well, a few words about our plan and our ESG rating base and the reports we make regularly. And this month, well, the day before yesterday, we had an update. We added 100 Russian companies from 19 industries, and this includes 19 largest Russian banks in terms of revenue, and so we have things to share in terms of sustainability and ESG evaluation of the Russian banks. Our reports can be used by investors when they build their investment portfolios satisfying the requirements of responsible investment. And we have tried to bring all our database to one slide. That's not easy. You can see the titles are quite small, but we will share this following the webinar. And now let us talk about the Russian banks which are part of our base. As I mentioned, we have assessed 19 banks, and the table shows that the top 5 are the largest banks of Russia, like Sber and VTB Group and Gazprom Bank, and we also have banks which are part of international financial groups. This is primarily related to responsible finance practices in these banks at their headquarter level. So more than 50 banks got the moderate high ESG risk management level, but this is not true for the environmental risks. They're quite poor, and the diagram to the right shows that the environment-friendly assets have the lowest score here, and this is really important for bank assessment. Apart from energy and utilities consumption and paper consumption and waste production, we also assess indirect impact on the environment, which is the most important one. And this happens through the lending and investment practices. And as you can see, the score is the lowest here for very poor information disclosure, because the banks are just moving in this direction and they don't pay a lot of attention to this. We have assessed the environment-friendly assets using a number of criteria. Let me mention them here. Here we assessed the investment and the credit portfolios. We considered things like a strategy or policy for responsible finance, and we also considered the bank's participation in framework and international initiatives like responsible banking principles or the UN Global Agreement Equator, Poseidon, and other principles which show that the banks are committed to responsible investment and credit practices. Then we considered the way the banks show the environmental allocation in their portfolios, and we assessed the impact of their green investment. I'd like to say that this was very difficult to do because the banks hardly have any allocation like that in terms of assessing the level of greenliness of their portfolios. So we also looked at the share of investment. We don't have this detailed information available for any of the banks, so this makes our assessment more difficult. This slide gives a comparison of top 10 banks on a number of parameters related to responsible funding. Number 1, international initiatives. So you can see that only 4 banks are part of these initiatives, and 3 banks have a plan to sign these initiatives in the near future. These initiatives are usually used by big international groups like Société Générale, UniCredit, and Citibank. They have signed a number of initiatives. We also consider policies in green finance, and as you can see, these policies, well, quite detailed policies, are present only with the international financial groups. whereas the other banks in Russia are now developing these policies and programs, or they are introducing them. For instance, we can mention Sber and MKB and VTB and their efforts to introduce their strategies and policies. And these are, in more general practices, present with more international banks. The share of green investment and credits, so you can see this assessment is pretty low, and only 4 banks managed to undergo this assessment. So we can see that the information is very fragmented. So we either see that the bank has invested into renewables, or they have a loan related to the ESG ranking, like Sberbank, for instance. We have cases when they issued sustainability linked loans, but this information is not disclosed voluntarily by anyone. Let me mention a report, a reference report from the Bank of Russia. It was published in May last year, and I believe that this is the only document trying to bring together the practices to assess the climate risks in the financial sector and the key barriers as the central bank sees it, the uncertainty of the climate scenarios, lack of technical knowledge to run risk assessments like that, and lack of high quality data by the industries to assess the climate risks in the bank's credit portfolios. And the regulator believes, well, and I believe the steps are going to take place this year, banks should arrange constant monitoring of climate risks, to interact with international regulators, and they'll be demanding a stage-by-stage disclosure from banks for better awareness of the potential investors. And I believe that this can impact the ESG assessment, and the banks will improve their assessment as they disclose their information. Thank you. Thank you, Denis. As Elena has mentioned, many banks have a potential to improve their ESG positions if they disclose more. So they might have some green assets and green initiatives, but they are hidden somewhere. Now we are still in the polling process. Not many people have participated, so we are calling on you to do so. Denise has a slide mentioning the next workshops. So the next topic will be sustainable development and the ESG rating of the Lipetsk region. Okay, thank you, Denise. Polling is going on.
So I'm heading to the next speaker. Axel, please connect.
Just a few words where I come from. So I have some 25 years experience in sustainable finance. I turned 50 years last year, so I spent half of my life on this topic. I did a bank apprenticeship at Commerzbank Hanover. I studied business administration, focusing on environmental management and also asset management. And then, and this was my best year, actually, 1995, I worked in London at the Global Care Fund with a very innovative team with Tessa Tennant, who launched laterwards the Carbon Disclosure Project, and also Anne-Marie O'Connor. She is now in Australia at a big pension fund. And Mark Campanelli was also part of that team. He later launched Carbon Tracker and then spoke for the first time about the carbon bubble on Earth. So it was very lucky for me to be in this team. So I tried to be as innovative as they were or still are. So I was a member of the executive advisory board at Hypovereinsbank in Munich in 1999 to 2001, dealing with environmental management. We launched the first investment product worldwide, licensing the Dow Jones Sustainability Index in October '99. I wrote a PhD about sustainable banking. So what is sustainable banking? Because earlier we talked about environmental banking, but now it was about sustainable banking. So I spent 5 years on this topic, ended up with a actually German book of 600 pages. And then between I wrote so during I prepared my PhD thesis, I was a scientist and a freelance consultant, and I wrote quite a lot of different surveys. If you're interested in these, you can find them on the publication side. But so the main one of the main topic was actually SD KPIs. That's where I'm talking today. So this is why I jump to this STKPI standard side. So the sustainable development key performance indicators are 3 particularly material, environment, social, and governance indicators for the expected business development of 68 different sectors. Actually, when we go down here, you see it's quite a lot of publications. The first one down here was called, it's a German one actually, but it's called The Climate is Changing, and Integration of Financial Risks and Opportunities into Financial Reporting. So this was 2004. Today you would just say this is TCFD. More or less. So yeah, this is a problem of my life. I'm always some 15 years earlier than the mainstream. But of course, maybe I could also tell you something about the future, where to go to. So one year later, it's actually all about the European accounting directives. The European Accounting Directive was a starting point for this STKPI development. The whole set here is prepared on behalf of the German government and with other partners. So Deloitte, for example, of course, a big 4 accounting company. In 2006, we surveyed the DAX 30 companies, what they think are the 3 most important indicators which they are going to publish according to the new accounting law. And the new accounting law said you have to disclose non-financial key performance indicators in your annual report, not in your sustainability report, in your annual report, but only if they are relevant for your particular business. Relevant for the particular business. So in those days, I was a young scientist and I thought, so what the hell is relevant? Yeah, because it is still not in the law until today. And this is why I produced all this publication. So first we asked the companies. The problem was the German automobile industry is quite large, but they did not mention that the fleet consumption, CO2 emissions are relevant for them. So we said, okay, if you don't tell us your right key performance indicators, we only ask your biggest target group for the annual report, which are investors and analysts. So all I'm telling you about now is a shareholder concept. It's not a stakeholder concept. It's really a shareholder concept because long-term shareholder, if you really look at Rappaport defining long-term shareholder value, it includes sustainability. So it's a shareholder concept, and we asked since 2007 only investors and analysts to define what are the sustainable development key performance indicators. And we did this here for the first time for 10 branches. Then 1 year later, we looked, so what is a best practice reporting for SD KPIs? I better go for the English side here. So for example, this is something which is still, this is actually the #1 professor for accounting in Germany. So Professor Doctor, so 3 doctors, yeah, very, very famous guy. And I just show you one thing, how is, in those days even, yeah, we already defined SD KPIs for banks. What are the 3 most important ones? Yeah, credit check for sustainability risks and opportunities in commercial and investment banking, credit checks for sustainability risk and opportunities in retail banking, and integration of sustainability aspects into asset management. Yeah, so these are the three by far most important KPIs until today. But what is also very interesting is how should you disclose these? Yeah, what is best practice reporting? Not just to mention an SD KPI, but to explain the economic importance to the investors. Do this quantitatively, please. Do not write lots of pages, make it as short as possible, but make it quantitative as far as possible. Do a trend analysis. Where do you come from? Where do you want to go? And then finally, benchmarking against your peers, like the other Russian banks, for example. Yeah, and one thing I would like to show you, this was BMW already in 2007. You see, they disclosed their fleet consumption starting 1990. Yeah, and it's going down and down and down. Yeah, so this was really best practice reporting. Okay, so I want to show you maybe this was a first a big next step. In 2010, we launched the first global standard for material ESG KPIs, which is still today the number. It's a very hot topic in these days. In 10 years ago, it was not a big topic. STM is very much market oriented, so we kept calm a little bit. We didn't tell too much to the audience worldwide because we had to wait for this 15 years of development, which I told you about. I'm always 15 years too early. So now is the market timing is really perfect, and that's why we really tell the audience in the word what we developed in the past. So in 2010 we surveyed the leading ESG research providers globally. Yeah, so we had from France, Crédit Agricole, we had Dexia from Brussels, we had Ethics and GS from the Nordics, we had Hermes, this is the engagement provider of the British Telecom pension scheme, the largest pension scheme in the United Kingdom. We had IRIS from London. We had the Risk Metrics Group. This is now part of MSCI ESG Research. MSCI ESG Research was founded in 2012. They always tell you not the truth, that they lived there for quite a long time. They were founded in 2012 because they bought quite a lot of companies in the ESG research space. Sarrazin is a Swiss asset manager, Societe Generale, Sustainalytics, and this was also quite unique. This was a social investment from Japan already participating in 2010 with 5 different analysts. And Vigeo is from France, the research provider. So what did we do? Again, very simple. I like simplicity because, you know, subprime risks and so on, this was a problem of complexity. And you can also do ESG very complex. But I think less can be more. Please focus, especially if you might start in these days in Russia, please focus on the material issues, and because this is what investors want, and this will even bring you out performance in your loan books and in your asset management industry. So what we did was, for the first time, not only to define it globally, but for 68 different industries. So this is the global industry classification standard called GICS. Global Industry Classification Standard is a leading industry classification on the capital markets. It's defined by MSCI and Standard & Poor's. And so we have 68 different industries, and we went through all these industries and asked all the participants globally what you think are the 3 most important indicators. And so they answered like here, yeah. All the answers are disclosed. We finally grouped the answers to find what is SDKPI 1, what is SDKPI 2, and what is finally SDKPI 3. And in one last step, we also looked at the reference. So what do you think? How can you split up 100% of reference to 3 SDKPIs? And this is done through all this different 68 industries.
Axel, I would
yes.
like to remind about timing.
Yes, of course. Yeah.
Mm-hmm.
Yeah, I'm almost finished, because 2016 was we review the standard every 5 years again, and so here you can find the Russian version now, which Svetlana talked about. The only thing we changed was that it's now a global standard of standard, because there are more and more standards popping up worldwide, and in 2016 we had a collaboration with a sustainability accounting standard board from the United States. They have 80 industries and 5 to 15 KPIs. We have just 68 industries and 3 SD KPIs. So this is the Russian version, which you can download, and the next version is currently in the development process. There will be 2 PhDs covering this, one SD KPI standard for corporates, and a second SD KPI standard for, even more important, for sovereign, so for countries and sovereign bonds, which is of course by far the largest asset class on earth. And both will be is planned to launch at the World Economic Forum in Davos in January 2022. Last sentence, maybe we also have a SDKPI database covering more than 12,000 companies worldwide with a history since 2009. And we have also capital market indices for equity and corporate bonds, which all have outperformance effects. So you just take standard indices, you underweight very easy according to SD KPIs, and end up with outperformance in the long term. So there is no problem anymore, like with green bonds, which heavily underperform in these days. You have a very light green approach of investing. And this is something which is very, very easy to sell, of course, on capital markets. Just one last sentence about my second role. I'm also a consultant at ZEB. ZEB is a Germany consultancy, and we have also in Moscow office.
Sorry, we're really,
yes.
really
okay.
short.
Yeah.
Now.
We also have.
We can drop the links and materials in the follow-up email to
nice.
all the
yes.
participants. I already dropped a link here in the chat to the book with SD KPIs in Russian. It was very interesting to work together with Axel on translating those standards, and I hope we'll have practical examples of implementing them. So we finished the second set of polling, and we will now launch the third set of polling, which is very, very simple. And in about a minute, we can start with interpretation of the results. In meanwhile, you can drop questions in chat. I see there are already a few small questions. And we will go to the Q&A part. I think on as these standard, Axel, we can have a separate also webinar on implementing it in Russia. So once our readers have like a bit of time to read it and to find some practical solutions.
Yes, I'm very happy that we made it until today. So just in time, as always, Svetlana, thank you very much. And for you and your team, very helpful to have you as a collaboration partner.
Yeah, so thanks. It was also a good experience for us. So I see we have 23% of people who answered on polling, and we need to reach hopefully a bit more. So 1 minute for the polling. And Gregorio, Elena, you will be interpreting the results of the first 2 sets. While we wait for the polling, Elena, there is a question to you in the beginning about the standardization for opportunities, for climate change opportunities. What do you think about that?
Which one? Could you kindly repeat it?
It is a bit of a long question from Mikhail. So you said that there is a need to formulate a single standardized framework of climate change risk assessment, and you mentioned opportunities for banking sector. What do you think? Is it necessary to simultaneously discuss the need of formulation standardized framework for the banking sector opportunities assessment?
Yes, that's what my colleague always just claim, that I should pay much more attention to opportunities rather than risks in presentation. So I absolutely agree with this question. I think that it should be assessed in a comprehensive way, just and in such a way, just we will reach the systematic approach, because just if we push something, just we stop business if we just concentrate on only on risks. But if we also focus on opportunities and what they bring, so then we have a leverage and systematic approach, so that we also want to do business, not only just to stop our business. And look at the areas where just more business is upcoming and where opportunities are. But unfortunately, there is no understanding yet, just about new technologies, and that's why just more knowledge is needed, just to properly evaluate both.
I think from my perspective, I also think that some standardization and guidance is needed, especially for Russian market, because for Russian market, it is a little bit short planned. All the risks they realize in a bit longer period, and banks and everyone need to understand what are the opportunities. Why should we engage in this?
I like one word that I came across, and I just keep on repeating that these risks are not linear, just we're used to linear risk, that if A, then B, C, and D for sure. But in this case, just this B may take place like in 10 years or never happen. And that's why just we think, maybe just it's not for me. So that's why just it becomes not manageable. So I think that the main approach is just to manage risks, just to be aware of them and to manage them. Resilience is very important, because you have to respond. If you look at different countries, for instance, how Japan responded to their bad weather events, and how just Haiti responds, just these countries, they are recovering just in a quite different pace. That's why just one country is more prepared, just to face and to deal with the consequences, and the other one just unprepared completely and totally.
Yeah, the risks may never realize, or they may actually kill us all like dinosaurs. So it's better to manage them on time. So with polling, we have quite good results already. So I'm ending the question, and I can share the results for all questions. Tom, Gregorio, be ready to comment with your English version. So I'm sharing the first set of questions, sorry. So who would like to be commenting it?
Yeah, so I think we can see that the majority of people said the 60% responded to that number 4, which is the carbon pricing risk. Is that correct, Elena? More stringent regulation.
Yeah, more stringent regulation.
Yeah, yeah. I think that's I think that's pretty expected one, and that's why we chose also to demonstrate that risk, explain how a carbon pricing tax might impact the operating profitability of a company. I think that's very much a risk to those companies that are engaged with counterparties that are in those carbon intensive sectors. So definitely want to expect on that particular one.
So should I open the second set now?
Yeah, unless Elena or Tom have anything to say about question 2, the main opportunities, development of new products and services came up as the top one.
Yeah, sort of mirror image of the first, isn't it? So that's fine. I think maybe we look on to the next one.
Now you should be seeing the second one. It's quite similar to the previous two webinars, identifying risks and opportunities.
And I think that's typical of most businesses, right? Businesses are very good at understanding, beginning to identify what the risks and opportunities are. But what we can see in this one as well is that the quantification and the scenario analysis are the areas that businesses are having most difficulty with in terms of how they go about converting those perceived qualitative risks and opportunities into a quantitative analysis of the business model. So,
I like question 3 from this polling. This one is different from previous two webinars.
determining which risk to prioritize, or
which team in your organization is responsible for TCFD, and banks honestly reply that for 50% from them, none.
Okay. Yeah.
Normally we have something like sustainability or
so risk management. Yeah. Okay. Yeah.
So that okay, that's not.
Very transparent.
I believe it's the basic stuff, just and most important. On one hand, it is basic, but on the other hand, it's the ultimate goal, just to evaluate and to identify risks and opportunities. Yeah.
I think also it's quite a clear cut between basically 100% of the respondents have said they have not disclosed TCFD yet, which is quite a statistic. And then we're also seeing that a lot of them are planning to disclose within 1 to 3 years. So clearly we see a lot of banks in Russia hopefully disclosing in that time horizon. And I think they're seeing technical knowledge as a key barrier, as well as climate risk disclosure not being a priority for the business at this moment.
The regulation not requiring it either is obviously key to that.
Yeah, exactly.
Yeah, but I mean, the regulation is the one thing, but I'm the market guy, and so I think regulation like taxonomy in the European Union is nice, but it's totally misleading the markets, and that's why green bonds are underperforming by 20 basis points. So we have to find a way to achieve outperformance. And so, for example, when Olga told me in Moscow, and our colleague in the ZEB office, that she's working together with the Russian Development Bank, and that they have really a new focus now to, let's say, route capital into climate-friendly projects in Russia. And there are so many inefficiencies. I mean, you for $1 or €1 or 1 ruble, you can achieve so much more regarding energy efficiency in Russia than you invest the same amount in Europe, for example. So there are really very good business opportunities in Russia for these climate change investments, and Russian Development Bank is supporting this, and this is great.
Absolutely, no, I think that's good.
Russian Development Bank is a quasi-regulator now.
Okay, both supporting and regulating. Okay.
So there was a question in chat from Maxim. Do you think that TCFD recommendations should be mandatory requirement for publicly listed companies in Russia, UK, or EU? So let's have it probably like a blitz answer, yes, no, from all the speakers. Who would like to start?
It is already.
It is already. Yeah, that's exactly what I was going to say.
Yeah. For Russia, no. So do you think it should be?
Yeah, it should be in the concept, like in the European Union, focusing on material risks and integrate this into loan origination. This should be in the law, not climate especially, but material risk, like in EU accounting laws since 2003. That's my simple answer.
So I will launch now set 3 results. So set 3. For some reason, it shows that 104% found it useful. I think it's a technical
That's a good
bug.
result. I'll take that. So that's great. No, good to see that there's positive response to the the polling and the audience.
This is what happens when you have a webinar with Russian audience. 104.
Well, look, it's good. I mean, the other thing that we were to mention is that obviously the slides in terms of the step-by-step approach to how you conduct TCFD analysis are obviously going to be available following this this webinar. The other thing we have done as well is develop a guidance document as part of this project. So again, that will be available, I think, on RAEX. You're able to put it onto your website as well, so that everyone can be able to access that.
Sure, we can also put it on a Telegram channel as well. A lot of people read the news there.
Great. So yeah, no, encouraged by that. And in terms of other people's comments, in terms of the other questions on there, the more information on sector-specific guidance is a key theme in that final question by the looks of it. Have I got that right?
Yes, I think materiality is really key sector specific. My best example is COVID-19. Yeah, if we would optimize all sectors regarding climate change, we would not have BioNTech vaccines. Yeah, because you have to cool it down with 70 degrees. So this is a climate killer. Yeah, but of course we want first to be healthy and then climate friendly. Yeah, but so in pharmaceutical industry, you don't go for carbon. You don't go for carbon. Yeah, you go for health, and this is just one very good example why you have to do it in an industry specific manner.
Yes, agree. Yeah.
So I think we answered all the questions in the chat except one question from Rustam. It's a little bit specific and off topic. Rustam, we will connect you with Axel and you can discuss this question later. So any final remarks from the speakers? It was very interesting, a series of carbon webinars, 3 webinars with Carbon Trust and EthnoExpert. Final remarks on this series?
No, yeah, thank you, Svetlana, for the opportunity of hosting these series of webinars with the different sectors. It's been really interesting to see the questions come through and to see the reactions in the polling as well. So hopefully everyone's found it helpful. As I mentioned, the slides are going to be made available and the guidance documents as well. So please do reach out if you have any further questions on regard to TCFD analysis to us. So thank you.
Thank you for very interesting presentations and educational input to Russian market.
Thanks very much.
Thanks for organizing.
So thanks to all the speakers, thanks to all the listeners, and we will meet again next week as usual with discussion of ESG rating and impact for regions. And last week of March, we'll have a webinar on the ESG ranking methodology and using the ranking. So we are continuing with the series. Thanks everyone. Have a nice day and see you on webinar 41.
Спасибо.
Thank you, Svetlana. Thank you.
Bye.